There's one idea in investing that's really, really, really important, but most people overlook this idea. And I think that's the balance between diversification on the one hand and concentration on the other hand. Now, what's diversification? It's simply splitting up your wealth in different asset classes that are hopefully not that highly correlated to one another. So you want to have a bit of money maybe in property, a bit of money in stocks, and a bit of money in crypto. And the idea is, why do you want to have this in these different things? It's because sometimes one thing might go up while the other thing might not go up. And when there's a crash, your other asset bucket might not crash. And so the overall risk in your portfolio isn't that massive, right? If you've got all your money in crypto, then of course you drop in Bitcoin by 70%. And then your wealth drops by 70%. And if you've got saved up quite a bit of money, it's maybe hard to recoup that money again just by saving, right? So you want to split this up somehow, because even if crypto falls by 70%, the house prices, they might be relatively stable, right? And so sometimes you might be able to even shift things around. So say when Bitcoin is really shooting through the roof and the property prices aren't yet increasing that much, you can take some of that money and then use this as a down payment on a house, for example, right? Then you rebalance your portfolio again and you hedge yourself from this crazy volatility that happens in each individual asset class. So that's the idea of diversification, and it's super valuable. And a lot of people do this already. But then the problem is people overlook how they should then specialize, how they should then focus on individual assets, right? Because the problem is you can't be an expert in every single of those asset classes, right? Can you really be the best scouter for the best house in the area and at the same time find the best altcoin in a market, and at the same time read all these balance sheets of different companies and find the best companies, right? It's kind of overwhelming. And the problem is also it's hard to beat the market in all of those different markets, right? Because only the minority even beats the market. 80% of the profits are concentrated in only 20% of the assets. So you have to pick the 20 best percent of the assets. So when you pick an individual asset, it's very likely you're actually underperforming what the general market is doing. And so when now you've got 3 different markets, you have to find the 20% of the winners within the market. And that's just a mess, right? How can you deal with this? So how can you actually practically really diversify? And so what then happens, what most of the time happens, is people think, okay, I can only focus on one asset class anyway, so I'm now going all in on property. I really become good at finding the right deal, at maybe fixing up a house, at flipping houses, or at renting them out really profitably. And then they completely ignore, say, stocks or crypto. And when then the housing crash comes, then those people have a problem. So what do I think is the best approach here? I think the best approach is to still focus on one asset class. So in our case, right, this is a crypto channel. I personally focus on crypto. So I try to find the right altcoins at the right time, where things are overvalued, undervalued, etc. I try to predict the markets in a certain way. So that's my personal focus. But other people might focus on property, or other people might focus on finding the right stock. But I pick one market, and then for the other 2 markets, right, I try to simply just mirror what the general market is doing. So for example, for stocks, I have very few individual stocks. I mainly hold ETFs, low-cost ETFs. So I simply just get what the Nasdaq 100 is doing, and I don't even try to pick the best company, because I don't have enough time to figure out what an outperforming company is. And if I just take a random company, or if I take a company that I've remotely heard of and I invest in that, then I still have an 80% likelihood that I underperform just the ETF, right? So I simply just try to mirror the market in those 2 other asset classes. I still try to be invested in them though, right? Because I do want the diversification benefit, I do want the low correlation, but at the same time, I don't try to beat the market. I don't try to get an edge. I only try to get an edge in a single market. And in that market, you really have to focus in, and you have to try to be as good as possible. And now the question is, what's kind of like the market that you should focus on, and where within a market should you focus on? So when you decided what's the best thing to focus on, like what asset class, is it stocks, is it property, or is it crypto, then you can narrow this further down. And the best way, I think, to narrow this down is to look at what part of the market is the least efficient. Now, what's efficiency of a market? It's how much mispricing is there in a market, right? When there's a lot of mispricing, so a lot of people that are not really deep in the market, they're not really informed, then you've got a higher likelihood of outperforming, of generating alpha, right? When you've got a benchmark, but you've got a lot of people that don't really know what they're doing, then it doesn't take that much skill, it doesn't take that much time and investment to be better than the average. So when you go with property, for example, right, I wouldn't focus on the big cities where there's already a lot of property agents, where there's a lot of transactions all the time, and people have all kinds of analytics to find out what the best deal is, right? When there's a lot of professionals in a certain market or in a certain sector of a market, it's unlikely that you can beat the mark without even being as good, right? So you have to make this then your full-time job and be even better than all the other people. So when going into property, if you want to make an edge in the property world, it's probably the best to look at the property that's rather neglected, right? Maybe not the best residences. Maybe look at houses that are second or third tier, that have a higher yield, where you can then even generate a positive cash flow on it. So in the end, if you want to finance more houses, that's no problem, because you're getting more and more cash flow positive with each financing of each new property. At the same time, there's probably not so many professionals in those second and third tier cities. So somebody might want to just sell their property and not 100 other people are directly seeing this. So you've got more of a chance to find deals and to outperform. So that's what I would do in property. When I would focus on stocks, I would also not focus on the top 10 stocks, right? Because there's a lot of people like full-time analysts in banks that are always doing all kinds of projections, and some of them might be right, some of them might not be right, but still there's a lot of eyeballs on these particular assets. There's also a lot of money that's being moved in and out of those assets. So getting the price of an asset is really worth it, even for high institutional, for large institutional investors. So they can invest a lot of money in research into larger stocks. So if I wanted to outperform the stock market, I would be researching possibly hundreds of small companies, of small caps, because the small caps, they're not being researched by the big banks, right? Because when they invest $1 million or so, right, it's not really worth it to put this hourly wage on analyzing all of this. It's way too little capital. But you, as a small investor, you can invest all that time, because say 20% on $1 million for a small investor makes a lot of sense. But 20% on $1 million for a big bank doesn't make a lot of sense. So you want to go into the inefficient parts of the market. So that would be then small caps for stocks. But at the same time, right, pricing inefficiency means also, if you're not informed enough, potentially more risk, right? So when you go into the second and third tier cities for property, or when you go into small caps for stocks, you're not really protected by efficient pricing that you have with the larger bets, right? So if you do a mistake, if you don't make enough research, then the mistake will also be way more expensive. So it goes both ways. But if you invest a lot of time in order to generate a skill edge, in order to generate a research edge, then those inefficient markets are the better markets. And so that's one of the reasons why I think crypto is currently so interesting if you specialize on one of those asset classes, because crypto as a whole, I think, is comparatively inefficient to property and to stocks. Because there's so many people that made a full-time job out of pricing stocks correctly, right? Tons of hedge fund companies, tons of professional property trading companies. So the competition there is high, right? There's decades of experience and billions of dollars in those markets. With crypto, the number of professionals is way smaller. So I think the inefficiency relative to the market cap is probably, currently this relationship is probably the best in crypto. And so in crypto, it's not even necessary to go to the cryptocurrency that's a super, super small cap. Because even within the top 50, top 100 coins, you see a lot of inefficiencies. So that's how I see it, right? You want to look for a market or a sub-niche of a market that's inefficient. You want to focus on that, and that's how you then generate the alpha, the outperformance versus the rest of the market. It's impossible, in my opinion, or it's at least very, very hard to own all of those markets, to be among the top players in all of those markets. So for the other markets, you just want to create the benchmark. So if that's crypto for you, just buy Bitcoin. Don't even bother buying 10 different cryptocurrencies. When that's stocks, when you don't, if you just want to mirror the benchmarks in stocks, just buy the ETF. And when you want to mirror in property, just buy something in a big city. It's very likely already relatively efficiency priced, where the bid-ask spread isn't that high, where you can buy something and you're relatively sure that once you sell it, you also have a pretty liquid demand. And when you rent out, you also have no problems renting this out. There's enough demand there as well. So there's less risk in going into established markets because mispricing is lower, but there's then also less opportunity. And if you grow wealth, if you want to get an edge in something, then you have to focus on this, and you have to expose yourself to the risk of the mispricing, which is then obviously also the opportunity. So I hope that's useful. This is how I see this, right? You want to find the right balance between diversification and concentration. Diversify across the different asset classes to reduce your risk, and concentrate in one asset class or one sub-niche of an asset class to then generate the alpha, the outperformance. That's how you balance this. And this is what I see being done wrong all the time, right? People try to pick individual assets, individual stocks when they haven't really researched them properly. They try then the same in crypto. They also haven't done enough research. And then you're just becoming part of the majority of the losers, and you don't want to be part of those people. Right? There's a different, similar kind of discussion discussing the current bear market, the state of the bear market. Hope you see that video over here. Hope to see you on that. And thanks for watching this one. Bye-bye.